How would you like to save $80,000 when you're buying a commercial property? Hi, I'm Joe Kraus.
And I'm Sam Powell, and we're the hosts of Property Pals Australia. And in this episode, we're going to be discussing the two key primary valuation methods for valuing a commercial property.
We also talk about the difference between commercial property cycles and the residential property cycle, and why it's valuable to know how they move and what lags the other one and why, so you can predict or start to invest based on understanding the cycles.
Yeah. We also throw a few examples out there too, and some key ones around how buyers agents can actually miss things and why it's really important that you're actually engaging in a commercial buyer's agent who has a really good in-depth understanding of the commercial property valuation process. So there's a few little interesting things there that you get a lot out of.
What I also love is what Jake's explanation of how he could save or was able to save somebody $80,000 on a commercial property, or could see an $80,000 valuation difference on a commercial property, and why it can be valuable to use a valuer, even if you're using a buyer's agent when buying.
Valuable to use a valuer. I love it. Yeah. The last thing, obviously, just understanding the path that Jake has come to get to where he is today is, as well as myself, we share a few little valuation histories, and we've been very close in our journeys together during this process. So I hope you get a lot out of it.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
Jakey,
Easy.
thank you very much for coming on the pod.
No worries. Looking forward to it.
Yeah, me too.
Good to have you here, mate. We're just
saying that. You were saying, Jake, that this is not like this is you haven't done this before, and this is going to be the same as like you and Sam just catching up what you normally talk about. And that's the exact reason that Sam and I started the podcast, is because I was buying some property and like speaking to Sam on the phone, asking him like a million questions, just being a total noob. And we're like, why don't we record this and like just put it out there? Because we're just mates having a chat, and it's good to bring on another mate and have a chat. We're actually reminiscing about our surf trip in the Ments before, weren't we, Jake?
Yeah, that was epic. I would go back. I might find it a little bit hard to get it across the line with the wife these days, with the 3-year-old. But yeah, it was just saying probably the best surf trip I've done. Having that wave out the front was just, it was epic.
Yeah, it was
special. You see the Kelly Slater's new wave pool in Abu Dhabi?
Crazy. Yeah.
I didn't get that. Could you try again?
Go away, Siri. Go away.
I was like, who else is here?
Did you let Kayla in while you
Yeah.
What's going on?
Wow.
Cool. I don't know. Like, I got so many questions for you, Jake, and I'm sure you do, Sam. I think we talk about how to value a commercial property. We've talked about like the different types of commercial property, but Sam, let me hand the mic over to you, and you start asking some questions, and I'll dip in as well, and we can hear from the pro, Jake.
Jakey, look, you're a senior commercial valuer with one of the large firms in Australia, and you've got a lot of history that we can tap into. And valuing commercial property is not as easy as I guess people tend to believe. There's multiple different methods. So what are the main valuation methods for commercial property?
Look, it sort of depends on asset type, and but look, generally speaking, you've got the primary approach in most investment cases would be capitalization of net income. So that's essentially looking at the net income of the property, and then we look to the market for yields essentially. And depending on market conditions at any time, obviously yields could be firmer or softer. And then obviously yields will differ between types of assets, and depending on, a whole range of factors. And then we have direct comparison, which essentially you could, looking at a rate per square meter on building area, lettable area, net lettable area. And they're probably the two primary approaches that we do. There are some other approaches, summation approach, which is essentially just what's the value of the land plus the added worth of the buildings. And then for some of your larger properties, like big multi-tenanted assets, we'd be looking at discounted cash flow modeling and IRRs and things like that, but less common in the work that I do, your standard commercial. But yeah, so they're the primary approaches.
Thanks, Jake. I'd love to break down those first two, or those primary two.
Yeah.
So you're saying, just like from the lens of somebody that's listening, is like, I've got some commercial property and I'm starting out in commercial property, and they want to move into, like, let's get me to the commercial route and cash flow when they can, when it's feasible to do so. And then, like, I just heard you say, all right, for the first approach is you're getting the net income from the property, and then is it correct in saying that you're going to the market, in that local market in that area for that same asset type, and looking at what the yield rate is, and then sort of coming up with a valuation from that? How do you get a bit more specific around that explanation, I guess?
Yeah, so like the way that we would sort of break this down is, so first of all, we look at the rent. So just taking a very simple single tenant property example might be, say, an industrial unit that's tenanted. What is the income of this property? And typically what we do is we'd look at the gross income. So a lot of leases are struck on a sort of a base rental amount plus the recoverable outgoings. So we can basically consider this gross rental amount, and we would make an assessment about whether or not it was at market or not. So whether it was essentially, because sometimes you get these situations where the rental's really inflated for whatever reason, and that's something you have to kind of look out for. But essentially, you take your gross income, you take off the outgoings of the property, and that gets you back to your net income, and then essentially from there, it's all a function of yield, which, exactly as you said, we sort of look to sales evidence to demonstrate what yields are being achieved in the marketplace. And obviously yields will differ. So basically we had a situation during COVID where we had a lot of interstate investors investing in the local Gold Coast market. And basically some of the reason for that was the yields on the Gold Coast were quite attractive on a kind of national basis compared to what, say, someone in Sydney could get. They were a lot firmer, so the returns on the Gold Coast were more attractive. But yeah, does that kind of explain that first approach?
Yeah, I get it.
Yeah.
By firmer, you meaning lower? So
lower, lower. Stronger is probably the best word.
The way
what do you mean by that? So when you say that, Sam, like, just for us listening, like firmer or stronger, what does that mean?
Yeah, well, people are willing to pay more money for a same amount of income, right?
Yeah.
And that's what changes that yield component. And in Australia, there's obviously markets within markets. So Sydney and Melbourne have a firmer yield rate because it's just more established, and people see that as lower risk, right?
So a firmer yield is a yield that is lower yield. Like, say,
correct.
Like a firmer yield would be 5% when the average might be 7%. Is that correct?
Yeah. So essentially, someone's willing to accept a smaller return for the asset for whatever perceived. Generally, a yield is like it's sort of risk tolerance. So, that's essentially what it comes down to.
Yeah. Yeah, it's a bit to get your head around, and obviously that's why I want to get Jake on the pod so the two of us can throw a few things out there. But Jared's really, he's very interested in this commercial space, and we're touting whether this next purchase for him is to commercial or to build on his residential portfolio. So it's good, for Jake and I, obviously the numbers just sort of rattle around in our head and the language comes out. So Jared, I'm really I'm interested to see the questions that come out of you today, my friend. But the simple form that I try to look at it from the commercial base is, people are looking at that income play. It's a strong income investment, and it's just like from a risk perspective. People will have this mindset of, well, Sydney, Melbourne, I'm happy to park my money there because I have a feeling it will increase in value greater, and I'm willing to take a lower income. So that's that yield component, which is a direct reflection of risk from that component. And Jake and I were having a conversation offline today just around the differences between an investment asset and an owner-occupier in the commercial space. So, Jake, did you want to, because that sort of rattles into that next direct comparison method, do you want to jump in there?
Yeah, for sure. So, I guess depending on the buyer profile, it would depend which of those kind of two classic approaches we would have as our primary valuation method. So the capitalization method is obviously concerned with yield, which if we were looking at sort of an investor asset, the capitalization of net income approach would be the primary approach, because investors are basically solely concerned with yield. Whereas the owner-occupier market, they're generally more concerned with affordability metrics. So typically, if we're assessing a property on the basis of vacant possession, so essentially it's vacant and owner-occupier can move in, we would be primarily concerned with direct comparison. So we'd be looking at rate per square meter, rate per square meter of building area, rate per square meter of land, in kind of assessing value, just because as I said, an owner occupier, they're not as concerned about return.
And an owner occupier being, say, somebody that has self-managed super fund that they might be able to use to purchase a property as their workplace.
Correct. Correct.
Standard?
Yep, correct. That's probably the most typical situation.
Yeah. And so with an investor that comes into the market, like, they are obviously going to, probably use a buyer's agent. They're probably not going to go buy their first commercial property themselves. Let's be honest, like the amount of due diligence that needs to go into a commercial deal compared to a resi is so different, and like many nuances and risks that are not in resi. So they come to you guys, Jake, to get a valuation. Typically, I know that you guys do bank vals and stuff like that, but some outside investors come to you guys to do a valuation. How important is that when investing in any commercial deal?
Yeah, look, I think there's a lot more moving parts with a commercial property. So there's a few just different things to get your head around, and I think sometimes that is intimidating for people. So I think, look, generally speaking, it is worth, especially your first one, having a chat to someone who understands kind of the mechanics and the different elements, so that as valuers, we kind of look at things we have a bit of a risk lens just naturally, because essentially a lot of what we do is we're protecting the bank's security position. So that's kind of the lens through which we sort of value. It's not to say we're always trying to be conservative, but it's just sort of the nature of the profession. So yeah, look, I think it's very important. We would do the valuation, but I would give a lot of feedback around different kind of risk elements, like cash flow risk elements, asset risk elements, and then we generally will touch on kind of market conditions, which is equally as important. Sort of what are the underlying market conditions for this particular asset, because you have a situation where, like, you can't just say all commercial properties are performing strongly. We've got a situation currently where industrial properties in particular are the kind of not much supply, a lot of underlying demand. They've been extremely strongly performing for the last few years, and they're very much holding firm at the moment under weaker economic conditions, whereas conditions for office and retail assets are definitely more fragile. So it's important to kind of understand what you're getting into and all those underlying fundamentals, because you can kind of just think, yield is all that's important. And generally speaking, an office or a retail asset would reflect a higher yield to account for that added risk. But if you've got really weak, say leasing conditions, and if you lost a tenant in an office, and you couldn't find a new tenant, you're sitting there as as an investor with a vacant property generating no income. That's pretty risky. So it's a bit of a long-winded answer, but yeah, very important.
You touched on a really key point too, and Jared and I spoke about this last week around market cycles, and understanding them is even more fundamental, I feel, with commercial than it is with residential. My reasoning for that is obviously businesses are more susceptible to certain market cycle downturns, and there's a risk there too. My mind just runs into where we're at in that cycle in certain asset types. Obviously, you're based on the Gold Coast, so there's that there. We were obviously speaking about something as well, which I thought was quite important, is the differences between the different commercial assets, so your industrial, your office, your retail, and where they're at. So can you explain a little bit around, I guess, the risks that you're looking at in this current market with the around each of those main asset types, being retail, industrial, office? That's all right.
Yeah. I could probably speak to some of the macro factors that you might see nationally, but obviously I'm based on the Gold Coast, so a lot of my observations will be fairly Gold Coast specific, but where I can, I'll try and give some sort of broader commentary. But yeah, so the industrial market, as I said, absolutely ridiculously strong performer over the last sort of 3 to 4 years. That's very much been driven by supply and demand imbalance. Very limited supply of industrial properties on the Gold Coast relative to very strong underlying demand. And basically that comes down to essentially there's no more industrial land on the central Gold Coast. Essentially, Yatala would be kind of where most of the new estates are located. So we've just seen land values go through the roof. And that's actually and then also we've got a really, really, really tight vacancy rate in the industrial market. And that's actually a national kind of factor as well. We've got, I think, one of the tightest industrial vacancy rates of sort of many countries.
Wow.
So yeah, we're kind of seeing that across the board. The office market, obviously, as you could probably expect, it got smashed during COVID with a lot of people working from home. We had huge, massive vacancy rate blowouts kind of across the board. Interestingly, on the Gold Coast, we've had a very rapid absorption over the last 18 months. And I would say the office market's probably been sort of most improved out of those markets. We've seen, the vacancy rate tighten quite a lot. There's not really a whole lot of supply in the pipeline. So, but still, just generally speaking, a riskier, I would say, generally speaking, maybe a slightly riskier asset class. And you generally would see a risk premium for office investment assets over and above, say, a really good quality industrial asset. And then the retail space, obviously similar dynamics to the office markets, got pretty hammered during COVID with lockdowns and things like that. A lot of retailers really struggled. Vacancy rates in some of our core kind of retail precincts like Broadbeach, Surface, Southport, just, really, really elevated, which puts kind of downward pressure on rentals and just generally isn't, not ideal kind of setup. It's been slowly improving, but I would say still pretty fragile. And you sort of, because economic conditions are a little bit weak, you've seen this flock to, I would say, non-discretionary retailers, kind of supermarkets and things like that, as people move away from discretionary spending. Those supermarket anchored little retail centers have been pretty popular. But yeah, that's kind of a high level, broad overview of those kind of three main markets.
And there's for me, the reason why there's so much more there's not a lot of information out there around commercial, or not enough for people to be able to have the confidence to even go it alone, even though some people do. Because there's things that obviously we were talking about as well, Jake, was the differences between even those three asset classes. People just think commercial is commercial, but I mean, you're mentioning that. Can you just sort of elaborate so everyone else can obviously hear? Is the whole land tax component that that is a risk in these commercial assets as well?
Yeah. So obviously, land tax is one of your biggest. Well, there is a threshold for land tax. So if the worth of your property is below, I think it's 350 grand, but they average.
Does it change? Does it change from resi to commercial though? Like, is it still the same tax?
I actually don't know the setup for resi investments, because you don't pay land tax on a lot of residential properties, Sam. It's definitely not your principal place of residence.
Yeah, if it's outside your principal place of residence, this is obviously where my brain sort of ticks in.
Yeah.
The residential has a threshold of 600,000 for your personal name under investment. A lot of commercials held under trust structures, so there's similar land tax thresholds, and obviously each state is different. But under a trust structure is 350,000, which you hit the nail on the head on that front. And even speaking with Andy, one of our close accountant contacts, is there's additional premiums being tapped into that from the commercial sense as well. So, like the biggest risk for people to understand is, what do these land tax components actually have on your cash flow, and how's your lease structured, right?
Yeah. So with a commercial property, like, this is obviously one of the big benefits of a commercial property is you can generally, depending on the structure of the lease, but you can generally recover all property outgoings from the tenant. So it means that if you're obviously, as your government site valuation increases, your statutory expenses will increase too. So land tax will go up, council rates will go up, but if you're recovering this from the tenant, you're sort of hedged against those increases to a point. There becomes an issue where if it blows out too much, how affordable is the rent for the tenant? But sort of even within that, land tax is not always recoverable from your tenant. Land tax is recoverable for most leases, but if you have a retail property and the lease is subject to the Retail Shop Leases Act, you actually cannot recover land tax from a tenant under that particular lease. So, but I guess like what we're seeing on the Gold Coast at the moment is because especially industrial underlying land values have increased so much, and it's very much looking like they're going to continue increasing over at least the short term. You got this situation where your kind of land tax and council rates are becoming quite burdensome, and if you're not recovering them, it's going to erode your net profit essentially. So it's definitely one of those important things to understand.
So looking like if you're going to invest in an industrial or any sort of like commercial, I guess, understanding what the previous lease agreement was and if that was covered under or
100%.
is covered under the agreement when it's get passed to a new owner. And then also, I guess you could look at the environment, the competition out there, and like what are their lease agreements looking like as well, and are those lease agreements recovering that land tax, and is it a normality? Because change, right? If you like just bought a commercial deal and the lease ran out and you're like, all right, cool, I want to obviously have this land tax covered by my tenants, but you're in a location where that's not the norm, then you may not be able to find a tenant that wants to take on that sort of lease, right? As an example, I guess.
Yeah, look, I guess it's as you sort of hit the nail on the head with like what is the norm, and I would say for most like industrial leases, it is very much commonplace that you would recover land tax if there is land tax payable, that you would recover that from a tenant. But that is quite an important point. If you are looking to buy a commercial property as an investment and there's an existing tenant, it is super important to look at that lease really thoroughly and understand the different aspects of the lease. And sort of one of the obvious things to look through is, what's the structure of the lease? If it is kind of a net plus recoverable outgoings lease, the lease will actually explicitly outline which outgoings can be recovered from the tenant. And you do see some anomalies where, like, generally speaking, council rates, water, land tax, electricity, or your kind of utilities and things like that would be recoverable. But sometimes leases won't include repairs and maintenance. Management fees is a really common one, which is kind of rarely, or at least like not commonly, included as a recoverable item. But management, if you own a big property, management could be thousands of dollars a year that, if you're not managing it yourself and you're paying someone to professionally manage it, that's an expense you've got to cop out of pocket, but you're very well within your rights to actually put that in the lease and recover that amount from your tenant. So yeah, all that to say, really important to understand the structure of the lease and have a comprehensive understanding of the different elements.
Before we continue today's pod, I want to ask you a few questions. What is your property investment goal? What type of properties do you want to own? How many? What size valuation property portfolio do you want to own? And how much in net income do you want to be earning? Essentially, what's your magic number in passive income that you want to be earning? And do you know how to get there? And if you do you know how to get there in the least time possible with the least amount of risk? Sam and I have been helping people invest in property and build property portfolios for years. People who are now replacing their income through property, and we want to help you do the same. Right now, for a limited time, we are offering free property coaching to our listeners. We won't be able to do this forever, of course, so head to propertypowers.au/coaching. That's propertypowers.au/coaching to see how we can help you achieve your investment property goals. Link will be in the description too.
This is also where my brain goes into checking vacancy rates, because it becomes a negotiation every single time with your tenant, right? Like, if you're going to ask them to pay land tax, which is within the right of an owner, they might put their heels in the sand and say, well, no, we'll go look elsewhere. And you need to be willing to accept that, because they've got to do what's best for their business. But in a low vacancy environment, which we're currently in, it's very difficult for these tenants to find replacement rentals, essentially. So knowing where you stand in that cycle is really important too. But it's even just knowing these things, Jake. I know it's common sense like natural to yourself that you've been doing it for so long, but these are the complexities of commercial property that I just feel aren't being spoken about in the broader community, because it's not the glitz and the glamour, the high cash flow. It's amazing you can retire in one or two purchases. There is definitely risks there. And to make an educated investment decision, you've got to look at the pros and the cons on each deal.
I want to touch on the cycle, like you said, depending on where you're purchasing in the market cycle. You mentioned something, Sam, around residential market cycle and compared to commercial market cycle. And I've got a question for that, which I'm going to ask in a second. But I think it's worth stating and noting how we know you, Jake, and how Sam got to know you, because we haven't told this story yet, right? Like, you, and I think it's relevant because, Jake, you and Sam met when you were both working together as residential valuers.
No.
All right. Well, you guys tell me the story how you met.
Oh, Jake, you go. I'm going to drop Charles here. Charles on this.
We're going to get Charles on the.
You need to get Charles. Yeah, Charles is the missing. He's sort of the missing piece.
Yeah.
In how we met.
Yeah. So tell us the story though, Jake.
I literally can't even fully remember, but you're at Taylor Burn.
Yeah. So I was at Taylor Burn.
A competitor
to the big.
This gets juicy.
Heron Todd.
It's not that juicy.
No, it's not that juicy. But
yeah,
I think because obviously your father was the director of the commercial division of Heron Todd White, and obviously you and Charles went to school together, right?
Yeah.
Yeah.
Well, I actually didn't, but I was very close with all the All Saints boys. But yeah, spent a lot of time with Charles.
You poached Charles off me, so I had no one to hang out
with. Yeah. Did you?
Just because I don't know, like, this is like inner circle stuff between you three guys. So I just for people listening, you've got Sam. I went to school. Me and Sam have been best mates forever. and then Sam studied a bunch of property and became a residential valuer. Obviously knew Charles, who is now a friend of ours as well. But Jake, you were friends with Charles from school, from hanging out with that group.
Yeah.
We've all been on a surf trip together, like many years ago now. I think it was like 6 years ago, but maybe even longer. Maybe, around 6 years ago. But so Charles, so how did you, Sam, meet Charles and Jake, I guess?
Oh, Charles came and worked for Taylor Byrne as an assistant valuer. And yeah, then Charles and Jake were best mates. They went to uni together, right?
Yeah, we studied together. We pretty funny. We had a lot of the same jobs through uni, and then went on a gap year together, worked at the same telesales job to save for that trip. So we'd sort of always had overlapping jobs growing up, and then studied the same thing. Both studied property at UQ in Brisbane, lived together up there, and then I went to work for HTW, which my old man was one of the commercial directors at the time, and Charles went to a competitor on the Gold Coast. So this was basically one of the first different jobs we'd had, which is funny. And then I forget how long into the piece, I think Charles was registered, but I floated the idea of they needed another resi valuer at HTW, and I sort of had been speaking to Charles about it, and then we poached Charles, and then you came after, Sam. Is that right? I can't remember the order.
Yeah, I came after, and
so we just gutted Taylor Byrne.
Just took all their resi valuers. So Jake, you've never been a resi valuer, or you've studied?
No, so you just study property generally. It's not specific to resi or commercial. And then essentially, not to bore you with how you get registered as a valuer, but I had to do some training for 2 years. I started in the residential training pool, which is you're just setting up jobs. It's pretty sort of basic stuff. And then there was monotonous. And then there was an opportunity to pivot over into the commercial, kind of the commercial division. So I did maybe 6 months in the residential training pool, and then I went over to the commercial side of things, and did about, I don't know, a year and a half more training there, got registered, and I never actually valued houses. I never have. I've always valued commercial property. So that's sort of been my background. But
that's cool.
That's the difference between.
Sorry, Sam.
So that's the differences between the big firms and the littler firms. So Hare and Todd White is obviously one of the biggest valuation firms in Australia, and Taylor Byrne, where I started, we were a small fish, but I was able to get access to, my training was so diverse, from resumptions to commercial to development to residential. It was good training, but eventually you pick a path, and on scale, it was just a more attractive proposition from a career perspective to go work for one of the big ones.
Yeah, congrats, guys. Yeah, it's really cool to hear your career stories and how they formulated. And I wanted to sort of have that shared on the pod so people understand, we didn't just reach out to Jake and found you, because you're working, with, that firm. It's actually from, you guys have known each other for more than 6 years now, and same with Charles. And the reason I think it's valuable to share the resi side and the commercial side and the, I guess, the general blend of everything you guys have both learnt is because my question is, when you've got property market cycles, you've got the resi market cycle, and you've also got the commercial market cycle. My question is, because business moves a lot faster than residential, people are going to be less likely to be moving homes and selling, and it's a longer lead time to buy in and out of, I guess, maybe not buy in and out of resi versus commercial, but slower to move market. Would you see the commercial market cycle change faster than maybe the resi market cycle?
Yeah, that's an interesting question. Look, I don't know specifically, and admittedly, I haven't actually valued through significant market cycles before, to be honest. This is sort of I'm sort of in one now where we saw, obviously huge amount of rapid growth kind of during that COVID period, in the same way that the resi market boomed. And then we've seen this kind of at the moment, hasn't really fallen off a cliff. It's just, it's plateaued. Some markets are holding better than others, but I'm very much looking at what's happening and trying to learn because, this is sort of a novel experience for me. So I can't say I can't really talk specifically to that question, but I have spoken to my boss. Seems to think that the commercial market can be, maybe 12 months to 18 months behind sometimes the resi market. So if you start to see cooling in the resi space, generally there might be some lag before we start seeing similar dynamics play out in the commercial market. Wow, Sam, can you speak to any of that?
It's all crystal balling stuff. I mean, the overarching from the market cycles, a lot of it comes down to the psyche of the buyers. Your business confidence levels is really key for further expansion or consolidation on that front. And I would feel that the business market would be more in tune, like the commercial market, sorry, because they obviously lease to businesses. They'd be more in tune with where the consumer is at, because they're seeing their profits, right? And then but from a business perspective, and this is a really great argument between choosing what's safer, residential or commercial, is the commercial side is those businesses. I feel like they can see it coming sooner, but what they don't want to, reduce their business, and they obviously see ebbs and flows because they see their profit margins going up and down, whereas your standard employee just has their fixed salary, right? So they don't see the pain that the business owner does. So that residential market is a leading indicator for these businesses to go, all right, that's pulling back, and that's why the 12 to 18 month comment that you just made just rings a lot of bells in my mind. In that sense, but from an overarching market cycle, you're still going to see those down periods coming through. Like a business will do anything it can to maintain it being open, and they understand that they go in and out. I do feel like there's probably more emotion in the residential side of them over leveraging for that emotional. I want this home because this is my dream. Whereas commercial is more of a strategic numbers game. So do you have any idea around what the hold periods are, on average for commercial in Southeast Queensland?
I've got literally no idea on average, but I couldn't say with any certainty. I think probably another point that's important to raise is because you need a bigger deposit, generally speaking, to buy a commercial property is a bit more if things do swing a little bit and move, there's a bit more sort of fat in the way that people are leveraged, if that makes sense.
Yeah.
Whereas people can be absolutely leveraged at 90-95% on a residential property, but it's just not possible to do that on a commercial property.
Yeah.
So I think that's important to consider as well.
I want to ask you, Jake, around the commercial property. What sort of investors or owners are you seeing that are in commercial? Are they just have a large commercial portfolio, or do you see people that move from resi, build a portfolio, and finally get to the stage of now I can afford that deposit for a commercial deal? Do you see much of that at all? And if so, where in their property journey do they sort of might make their first commercial acquisition?
Yeah, I'm not as connected to that part of because I'm not necessarily directly acting as a BA. I don't always get the backstory on the deals, but as a general observation, kind of a new dynamic that I've seen in the last couple of years is obviously with the rise of the buyer's agency space, the fact that there's a lot of content and information out there. I think people are starting to wake up to the edge that commercial property investing have, or the positive differences compared to residential property. I think Australians, we love residential property, and for the longest time the narrative has just been buy a house, buy the next one. It's just commercial property hasn't even been on people's radars. But I think there is a growing awareness that it is a good option. Obviously, the needing a bigger deposit, there's sort of more barriers to entry. The education piece as well, there's a lot more moving parts. It's harder to understand. But generally speaking, definitely seeing people buying assets like, your mum and dad investors buying something in their super fund, or, a younger person, who might own a couple of houses now looking at a small entry level industrial unit for 500 grand. That's definitely, there seems to be sort of a rise in that space. And quite a few vals across my desk where there's, a contract in play and a buyer's agent has sort of been involved in the deal, which is, that's kind of a new dynamic over the last couple of years, and seeing, interstate money in the local market.
Yeah, that's the rise of the buyer's agent, right? Like coming out of us being valuers and then me changing into this space, and obviously the work that I'm doing at the moment, there is a lot of unperceived risk there for a lot of retail investors trusting people with, their own money, right? Like, I've seen a number of examples where I was going to say hundreds, but probably more like your 50 to 80 examples in my time of buyers agents not actually, doing the role that they're essentially being paid to do, which is have their client's best interest at heart. Do you have any examples that you've seen come across your desk where, just to, I guess, educate people on, it's your money at the end of the day, the buck stops with you, so you need to get educated and then work with your buyer's agent, not just trust them to do the best thing for you.
Yeah, I think super important to have a base level of understanding yourself, just because, I'm not trying to say all buyer's agents are negligent or not trying to do the right thing. But ultimately there is a bit of a, sometimes can be a conflict of interest where a buyer's agent gets paid for the deal going through. So maybe they're not scrutinizing things as closely as they should.
Yeah.
And then, you've got sales agents that are trying to, talk up the property, or maybe put some of the obvious risks in the background. They're not, they're trying to make it seem as appealing as possible. So, yeah, I think having an understanding yourself so that you can at least look at the deal a little bit critically too. An example of probably a pretty terrible deal that came across my desk was a little industrial unit in Mollendina. It was, I'm not going to say who the BA was, but it was a deal mediated by a buyer's agent, and I went out there, and it was a industrial unit, industrial area, industrial zoning, and it had fit out for a gin distillery and bar. So it extensive fit out, full little dining area. Yeah, real specialized fit out. I was thinking, okay, this is interesting. And then looked online, sure enough, there's no approvals for that particular use or the fit out. So there's kind of non-compliance risk with council. If they rocked up and issued you a show cause notice, that tenant might not actually legally be able to run that business from there. So that's pretty risky for you. And then there was a lot of mezzanine accommodation, like a mezzanine level in this unit that, when I looked into it, wasn't approved either. And this is actually a pretty typical example of how people can overpay. Often an agent will include unapproved areas in the total area of the property. And if you're buying on a rate per square meter, it's pretty easy for that to get overstated.
Yeah.
But, you shouldn't pay full freight for a bit of the property that's unapproved, because again, if council really wanted to, they could tell you to rip it out. So this property had basically all those elements.
So would you say it's wise for somebody that, I'm just thinking from an investor that is coming from resi. Maybe they bought 4 resis properties, and they're like, "Oh, I want to get into commercial." And you said there's a baseline understanding that you'd need to know, so you're not getting like obviously duped and played by a buyer's agent that may be charging 2% of the deal, the close price of the deal for their work that they do, which that is a terrible business model for the consumer. I see that with business acquisitions as well. As a buy side mergers and acquisitions advisor, I can charge 1 to 3% of a deal, but you should have a clause, I believe, of like how much you negotiate the price down from the asking price.
And like a performance.
Performance. Yeah. So just I mentioned that for people thinking about like who they're selecting as a buyer's agent. So if they need a base level understanding, I've got multiple questions in one. What it's like, number one is like, what is some of the base level understanding they should know? And then number 2 is like, would you suggest it would be worthy of getting a value after you've found a property that you're about to sign a contract on, commercial deal? Would it be worth having a commercial valuer, look over it and check it, or do a separate valuation? Because I have heard buyers agents actually suggest that as well too.
Yeah, I reckon definitely, especially if you've got a buyer's agent that's like operating, they're not based in that particular market. They might be a Sydney-based BA buying something on the Gold Coast. Like if they're not super familiar with that market, they might have a grasp of kind of basic valuation methods, but ultimately, like it really pays to know that particular local market. Is the rent overstated? Not just applying, these are the yields in Sydney, like applying that same sort of yield expectation to a Gold Coast market without really knowing where the yields are at on the Gold Coast. Look, I mean, it's like you could pay, if it's a small entry level property, $1,200-$1,300 to get a valuation done. Or if you've got the time, fully educate yourself. It's just like, what do you want to do? It might just be worth paying a professional who has a qualification, who is doing this day in, day out. Yeah, but if you're really interested in learning and you want to like throw yourself into lots of study, then by all means.
And I think most people that can afford a commercial property deposit aren't going to want to spend too much time. Well, they're going to want to learn, but they're obviously not going to want to learn enough that they can value. And how, for me, I do 3 years of learning, Jake, I'm never going to outperform you in terms of evaluation.
Yeah. Well,
like,
it's
doing it so long.
Yeah. Yeah. And like, as an example, that particular unit that I was talking about that had all the, unapproved use and mezzanine in it, I think the val fee for the bank was like, for that one was maybe $1,500, and I ended up putting about $80K less than the purchase price on that.
Amazing.
That particular valuation. And that was me trying to be like as optimistic as I possibly could. So it's kind of like, it's a fraction of what you could be overpaying. So to me, it's a no-brainer.
And this is the importance too of, subjecting your due diligence in your commercial deals is having a valuation report being handed to you of an external third party who has no, effect on the deal. I mean, for commercial deals is really important. I mean, there's obviously the finance side. Some people have cash, and when I'm putting offers on properties, the least amount of restrictions are obviously more advantageous to get a deal through, because obviously the seller, there's less risk on things falling over. But even still, even if it is a $500,000 purchase, it's a lot of money. And then, like, as you can see just by listening to this conversation, a small mistake, even under the eyes of a trusted advisor, quotation marks, can cost you $80,000. That's insane, and
that might be the title of the podcast episode: "How to Save $80,000 on a Commercial Property."
Yeah. Well, that's yeah, no, there's a lot to it. I feel like going back those that are listening to this, if you're enjoying this content, please leave a comment below, because obviously there's a wealth of knowledge. I mean, Jakey, you're a multi-generational commercial valuer. I'm not sure if you've thought about it that way, but your brain, I definitely had the same sort of thing when I left the valuation industry into the buyer's agent space. Is you're like, wow, I didn't give myself enough recognition for what I've learned over the decade or so that I've been just working, like doing your day in, day out. What you know is highly valuable, and we're really appreciative for you to be spending your time with us.
That was awesome. It was fun. Definitely do it again.
Yeah, well, awesome. We'll hold you to it. Jared, Jared's a man who's with all the questions, mate. So we might not be done yet. Jared, you got any more juicy questions?
I've got a lot of questions, but let's wrap it up here, and then we'll come back with another one and have a good chin wag then. And we should call out Charles. We should send this episode to Charles and say, mate, let's get on and have a good yarn. It'll be fun, I think.